I am Drew Edmond, an associate partner at Glenbrook, and today I am here to talk about payments trends that are occurring in the entertainment industry. In the movie Gladiator, Maximus asks the crowd, "Are you not entertained?" Well, apparently we are entertained, because the size of this segment sits at around $700 billion of payments volume on an annual basis in the United States, based on our analysis. At Glenbrook, we segment the entertainment industry into three domains of service: digital content, which includes video streaming and downloads, access and subscription to news, audio purchases, and subscriptions to things like books, stories, music, and podcasts. Second is events, such as sports tickets and reselling, concert tickets, and in-event purchases. And lastly, the world of gaming and betting, which includes console purchases, game purchases, purchases that occur in-game, and of course, betting. There are distinct stakeholders within this industry that are either performing a payment or receiving money for services provided. Consumers are certainly the primary buyer in this industry. After all, entertainment is all about providing leisure activities to individuals and groups of individuals. But we also have advertisers as a key stakeholder, as companies vie for the attention of these buyers and the dollars associated with their precious free time. Content creators are being paid for the materials they create, and distributors, agencies, and platforms provide distribution channels to bring those products to the end user. Like most merchants across industries, merchants in the entertainment industry typically want to increase sales, decrease costs, and improve the customer experience. How that is accomplished depends on the unique characteristics of the business, including the business models it uses, the characteristics of its buyers, the structure of its payments environment, and the degree to which it is using best practices to improve its payment operations over time. When we work with merchants like this, we are often trying to resolve key questions, such as how can we optimize revenue by improving authorization rates and managing chargebacks? Is the tokenization strategy effective, and does the architecture support our objective? How are the payment service providers performing? Is the relationship management proactive, timely, and accurate? Does the payment solution provide the features and capabilities that our business needs? What is our total cost of payments, and what can we do to reduce this cost while still maintaining the performance we desire? Are we effectively using payments data to manage the business? Do we have the right KPIs to track? And what are they telling us about the business or our customers? Are we effectively mitigating our exposure to risk? And do we have the right controls in place? Is our organization structured effectively to manage and optimize the payments business? I want to share an example of how we recently helped a global media publisher work through some of these issues. With this particular client, we had three parallel work streams occurring at the same time. The first focused on determining the optimal payments architecture that suited the organization's needs and capabilities, identifying payment costs and opportunities for cost savings, and analyzing the responsibilities that the payments environment dictated for the organization to determine whether the organization was structured and staffed appropriately to meet those responsibilities. The second work stream was related to the concept of involuntary churn. This is something that any subscription service is dealing with, and that is the loss of subscribers due to failed payments. We analyzed payments and customer data to come up with product, payments, and data recommendations that help to reduce the number of lost subscribers. Finally, it is common for merchants in this category to deal with fraud. Given this is the entertainment industry, this might come in the form of first-party fraud and policy abuses, but they are also exposed to third-party fraud perpetrated by others. For this client, we developed a comprehensive set of risk vectors and recommended approaches that help to reduce chargeback rates and improve risk mitigation across the payments environment. For merchants in this space, there are a variety of payments innovations that are relevant to consider. For companies that offer subscriptions, the use of third-party recapture providers can help improve the retention of customers by applying machine learning to transaction retries. Open banking, especially through pay-by-bank mechanisms, offer a lower cost and potentially higher success rate for transactions. Payments orchestration can enable dynamic routing, transaction retries, and faster access to new geographies. Embedded finance can come in different flavors, from consumer lending at the point of purchase, embedded insurance, or consumer wallets. And finally, generative AI tools embedded into fraud solutions may help reduce fraud. If you are a merchant or a stakeholder in the entertainment industry and are interested in learning more about how to improve your payment strategy, please reach out to Glenbrook.